Welcome to the Pump and Dump channel for another weekly update, this time looking at CNX resources, natural gas, oil, and then I'm going to talk about shipping because that's going to relate to oil in particular. So I talked about CNX resources I think last week when I talked about how Zimafu was rallying because the gold price was rallying. It rallied from like an undervalued situation to a full intrinsic value, and then it bounced off and it's been going a little down and sideways from now, but I also mentioned CNX here. It had, back in early March, it was still trading at half intrinsic value. It went to full intrinsic value and then it just sold off all the way back down to half intrinsic value. And now it's starting to rally again. And it's currently, I would say, it's about 30% premium to this half intrinsic value, but it could go back to full value. It's really hard to gauge. I think the main driver right now for CNX resources is the energy sector. Oil is up quite strongly today. Yesterday it was up big too. And what I think is happening is the money is going into energy stocks and not stocks, into ETFs and open-ended funds who invest into energy companies, and money managers there look at what is cheap, what can they buy, and they'll look at these natural gas producers and they'll say, you know what, these are cheap, let's buy them. And then you see that CNX resources being the cheapest, in my opinion. They just buy a lot of CNX resources, and that's why it's up 22%, and these other ones are up, less. If I just bring up something like a Pioneer, which is much more oil related, you can see it's down because it's overvalued. So the money managers, when you give professionals, they'll buy what is cheap. They won't buy what's expensive. So that's kind of what I'm thinking is happening here and why it's up so big. Getting to the bigger picture, oil of course is the main topic of the week. Trump announced, I think it was yesterday, he announced that he was going to broker a deal with Saudis and Russians about bringing production down, the supply down. And Trump of course is now trying to pose as a deal maker. That's kind of what he's sold himself as, someone who can make deals. And he's going to try and come in here and then say that he got the oil price off the lows from 20. I mean, of course, we were down at 20 recently, and 2016 the low was 27. And I thought, like, once we bounce above this moving average, I thought we would go up to this one here, but I wasn't thinking that we would go above this moving average right away, but we did, and above this technical resistance line, this 27. I thought we'd maybe bounce off there and then eventually come up, but we've gone straight up. I think in terms of the longer term outlook, 27 to 35 or 36 seems to be where we probably will be going the next couple of days and weeks. And if we do get some kind of an agreement, maybe we can eventually get back to 40, 44, 45, let's say, and longer term might get back to 50 in a year or two. But that's kind of where it's at right now. The interesting thing, of course, to note here is that the narrative and the fundamentals are trying to line up. The narrative at this point in time is, of course, Trump trying to make a deal, trying to help the US producers. He's of course going to represent the US. America first is what he's been talking about in his campaign in 2015-16, and he still talked about it when he was in office. So he's trying to put the Americans first, and of course he realizes that $20 a barrel oil, the entire US energy sector is going to collapse. So he has to either do something, or at least take the illusion that he's doing something to get this market up, to get the sentiment up, because he knows the traders, if they fear that there's going to be some kind of a deal to reduce supply, that could mean that they are short and the supply is shrinking and they need to get out. So they of course are forced to cover and push the price up. Now, what is interesting is the Russians, they seem to be okay with the low oil price, and when it broke down here, what they just did was devalue their currency, is what you would say, or maybe their currency just devalued for other reasons, who really knows. Key thing is that they managed, of course, with the currency devaluation to reduce their cost of production, so they're probably okay, the Russians. And the Saudis, I think, back when the OPEC talks broke down, I think they recognized, and I've mentioned this chart here a long time ago, well, not long time ago, but I'd say a few months ago, I outlined this triangle here, and I said that eventually get here and break to the upside, or maybe here, or we'd break to the downside, because obviously when you have a nice triangle, eventually you get to the apex, and then you have to go up or down, or you can't just stop there, right? So I think what the Saudis did when this whole Russian thing was collapsing, this OPEC Plus deal was collapsing, of course the traders pushed it down below the technical resistance, and it back tested and bounced off, and the Saudis, they just recognized they need to sell as much oil as they can whilst the prices are still above above 30. So they just announced they were going to increase supply, and they probably had sold quite a lot of oil into the markets to get as much money as they could before the prices collapsed, and that's kind of what you would expect smart people to do, right? So yeah, then we do have this collapse here, and the Saudis, they want to of course pose as being the leader of OPEC, and that they decide what the supply and is going to be, and well, the demand they can't really affect, but they're going to decide the supply, and because they affect the supply, they basically control the price. That's kind of the narrative they want to come up with. But when we're looking at the reality, of course, the demand destruction that came from the economic shutdowns due to the coronavirus have led to this decline here. Now the fundamentals, what is happening, which will force the Saudis to cut, and they will of course cut this year, I'd say in 3 to 6 months. They'll announce a deal has been made to cut supply into the market. It might be sooner, I don't know, but I'd say 3 to 6 months. They'll announce it when the price has already rallied, that they're cutting supply. And the story is going to be that when they announce, of course, that they're going to cut supply, they're going to hope that people will think that because they're cutting supply, it will make the price move up, and then they'll sell into those schmucks. But yeah, the thing is, they of course want to pose as being in control. This is like the royal families, of course, they want to act as masters to their servant classes, and that they have this power to move the oil price, and that they control the world and things like that, and all these ruling classes, or whatever you want to call them, they're all deluded outside of their mind, and they don't want to of course show weakness, that the market can do something to them. But when we're looking at the fundamentals, of course the fundamentals at $20 oil here, the entire US energy sector doesn't make any money. Well, not the entire, but most of it, like 95% plus, doesn't make any money. And the Saudis also are in trouble, because when you're looking at the shipping rates, at the low oil price, they just can't produce it and ship it to where it needs to go at a reasonable cost to get a reasonable profit. So this is kind of why I have this press release from DHT open. So DHT announced, on the 1st of April, that they have 6 VLCCs that are tied up on 1-year charters to store oil for some of the traders who took advantage of the oil contango that existed. Of course, that is dead, and that means that there are 6 vessels which can carry 12 million barrels of oil that are just sitting there holding oil and not transporting oil and offloading it and then going back and getting more. So you see that the vessels that are there to transport the oil are disappearing into these storage trades, or they have disappeared into these storage trades. So Saudis eventually will be forced to cut, because the capacity to transport oil is just not there. It's declining. The oil tanker companies have not looked to increase their fleets due to the current spike in charter rates and spot rates, and they're not going to do so for at least a year or two, because it takes I think 2 or 3 years at least to build a new VLCC or a Suezmax or whatever the ship is, because the shipyards of course need time to build, and of course with the coronavirus they're not going to be building new ships. So the supply of vessels of transportation is curtailed with these storage trade, and therefore the Saudis are going to be forced to cut. It's just about how they announce it and how they try to keep face, and that's just the way it is. And if I just look at the charter rates on the 1st of April, they were really high. If we look at the VLCCs down here, 80,000 a day, the charter VLCC, and Suezmax 53,500 a day. And of course what's happened is the stocks have sold off, the tanker stocks have sold off. The last 2 days they just basically collapsed back from their rallies that they had, and they've collapsed because the contango trade of buying in the spot market and holding it in a VLCC was max for a year and then selling it a year out has kind of collapsed. I mean, a few days ago we were at $20 oil, and that was for like 2020, and the 2021 contract for April, let's say, it was at 38. So you had an $18 a barrel difference, and with that you could have made some money at, you know, at the $67,000 per day for the VLCCs. And of course DHT would have not given these away any lower than this, I would say, because the spot market is just like really strong. It's like 200,000 a day, so why would they commit a vessel for like 50,000 over 6 months or something like that? They really wanted to make sure that they had long-term contracts to keep it at 67,000 to maintain high earnings for the foreseeable futures for most of their fleet, because I can't remember now the number of, it's 21 I think is VLCCs they have in their fleet. So like a quarter of their fleet or a third of their fleet is tied up in these storage, you know, storage stories, and those are just not available. So at 67,000 you could do that, but now the contango trade is dead because we have like $28 a barrel in the current month, and for April it's 35, so that's only $7. So you know, it just doesn't work at $7 when it works at 18. But the key issue here is that the market is looking at the storage trade being dead, and they're thinking that these tankers are just there for storage. But when you have less tankers in the market and you have producers who want to sell or transport oil, they're going to compete for the declining fleet, and that's going to mean that the rates are going to remain robust, even though they're probably going to decline from here, but they're going to remain robust for at least another 3 to 6 months. And I would say then, you know, going into the end of the year, the bull market in tankers will have died, and it will probably be another bear market for 5 years before we see the next bull market. But yeah, the tanker stocks have not gotten anywhere near their intrinsic values. They're still trading very wide, you know, below the intrinsic values. That's just the way it is. So that is kind of the story, I would say, for OPEC Plus, Trump, and so on and so forth. They just want to like hide the fact that the fundamentals dictate that supply has to go down or the price has to go up, and the reality of course will be that supplies will have to come down some and the price will go up some, and that will kind of like help the situation. But with like the tankers, that's kind of really interesting that the transportation is disappearing. So where's this oil going to come, you know, where's it going to go? You know, it's going to come from Saudi, but where's it going to go? It's going to go nowhere. So if they produce more oil, does it really matter? No. So yeah, that's kind of interesting. Next point, natural gas. Talked about this descending trend line and how we kind of peaked above and fell below, and we've had some bear flags here, like a very steep one here, and then there's another steep one there. But you know, it's kind of declining in steepness, and down here we have another one that is kind of wide, but it's flattening, I'd say. And the fundamentals, you know, you could still make a case for it going lower. Who knows, maybe to 110, 120, 130, who really knows. But in terms of how I see it, I think, you know, we've broken out from this downtrend, and I think from here we should have a rally to like $2, $2.25 on the current month contract. That will of course take place as we move through the summer and then go into the winter, and we'll see in the winter how much supply is still available, because I think a lot of oil and gas producers are in trouble. They have to either cut production, which means there'll be less natural gas there from the associated oil and gas producers, and the associated gas production from the oil producers. The main oil producers are going to have to cut back production because of the low price, or because they're going to go bankrupt. Companies like Antero Resources have no chance to survive. And yeah, that's kind of why we will probably see you know, a rally going into the winter this year. I think, you know, we could go back to $3, who knows. It doesn't really matter for CNX Resources, and that's why I like this company so much, is because they give us a hedge for the entire year. Whether the oil price goes down to $1 an MCF or up to $5, it doesn't affect their revenue. They have sold forward 94% of their production. Of course, if the price rises, they can produce more, make more money. But if the natural gas price actually fell, like let's say it fell to $1 an MCF, they would be buying in the futures market from whoever is selling and then filling their contracts, because they produce natural gas, like I think their cash costs are like $1.15 or something like that, and their all-in costs are like 160, 170, which includes, of course, servicing debt, which they, you wouldn't be buying here at 160 if you were CNX, but if you got like down to 120, $1.10, you would most definitely be buying in the futures market to sell into your contracts, because what is the benefit of producing an MCF of natural gas out of your reserve for a 10-cent profit on that, when you can just buy it in the futures market, and then you can just keep your reserve intact for when the marginal benefit of producing it yourself is like 50 cents or $1 an MCF. I mean, that's what I would do. So it'd be interesting really to see like whether CNX Resources will come in like the uranium producers did last year and the year before, with their hedge contracts where they sold forward production and then the spot prices fell so low that they just bought it in the spot market rather than producing it themselves. So yeah, that's kind of how I see it. That's my opinion. And of course, I'm not saying that anything I say here will come true. I mean, the best thing that could happen for someone who's looking to get rich is CNX Resources, for whatever reason, like a natural gas price that falls to $1 an MCF would fall to $2, and then you just go all in, and then you just wait like 2 or 3 years, and then you just make a huge amount of profit. That would be, of course, the best scenario. But given the current circumstances, this is what I like. So I like these producers that are hedged and who have like a long-term view, and they can just build their business regardless of what the price is doing in this year or this month or this day. And what's interesting is that I saw this too last time when CNX had this big move up. It was kind of when the Dow Jones was melting. The value was there for the natural gas producers, and that's why CNX Resources probably had this massive move up here, because everything else was falling in value and falling in price, and this was the only thing that was cheap and stable, and that's probably why the investors thought this was a great thing to buy back then. And then they came, when the Dow Jones and the S&P rebounded, they lost interest and they started moving out of this and back into that, I guess. Who really knows? So yeah, anyway, I'm going to leave it with that for this video update for this week. And remember, as always, it's not investment advice or recommendations for you to buy this stock or any stocks I talk about. If you like the content, you can of course subscribe. And if you have any questions, comments, or opinion on what I say, then you can of course leave that in the comment section. And with that said, have a good day.